Getting into a trade is only half the job. Managing it is where your discipline really gets tested. Welcome back to part 10. Today, we're focusing on what happens after you click buy or sell. In our last lesson, we looked at how to fill out an order ticket and set your stop loss and target. You should already know your exit points before you even enter the market. Once you're in, the most important rule is to follow your plan, not every single tick on the screen. Watching every candle move up and down can lead to emotional decisions that break your strategy. For swing trades, we often use a fire and forget approach. Set it up, then walk away. Staring at the screen won't make the price hit your target any faster, but it might make you exit early. Now let's talk about management. When your trade reaches plus 1R, or 1 times your risk, consider reducing your risk only if the market structure supports it. Don't just tighten it randomly. Moving your stop to break even too quickly often gets you stopped out right before the big move. When you hit plus 2R, this is a major milestone in your trade management. At this point, you might take your planned profit or start trailing your stop behind new structure. If you trail, do it by following the structure, like the most recent high or low in an uptrend. Are there times to exit early? Yes, but only for objective reasons, not feelings. If the market structure that justified your entry completely breaks, the trade is no longer valid. A very strong close against your setup might be a signal that the momentum has shifted. Or if major high-impact news is coming up and you're not in a safe position, you might step aside. But here is a golden rule: never widen your stop loss. If you're wrong, take the loss. Holding on to a losing trade because you hope it will turn around is how accounts get blown. Similarly, don't cut your winners short just because you're scared of losing a little unrealized profit. The difference between a gambler and a trader is a journal. You must track every single trade. We journal in R. Was it a 1R loss? A 2R win? This keeps your focus on risk, not dollars. Your journal should include the currency pair, the direction, and the specific setup you used. Record your entry, stop loss, target, and the exact amount you risked on the trade. Most importantly, note your reason for entry, the result, any mistakes made, and the lesson learned. Always take a screenshot of the chart before you enter and after you exit. Visuals tell the full story. Review your journal weekly. Don't get emotional after one trade. Look at the data over time. Track your win rate, your average win versus average loss, and your rule-following score. Identify your most common mistakes. Once you see them on paper, they're easier to fix. Your mini assignment, Journal 10 Demo, trades with screenshots and grade each one A, B, or skip before you enter. Remember, this is for education only. Forex is risky, so demo trade first and seek parental guidance if you're a minor. In part 11, we'll cover news and timing so you don't get blindsided by major events. I'll see you there.